The retirement landscape is about to undergo significant changes in 2025, and these updates could substantially impact your future retirement. Whether you're in the early stages of your career or approaching retirement, understanding these changes is crucial for optimizing your retirement strategy. As a financial planner who's helped hundreds of clients navigate retirement planning, I'm going to break down these important changes and explain exactly how they might affect your retirement. Hello, my name is Danny Gudorf, and I'm a financial planner and owner of Gudorf Financial Group. Let's start with what's happening to workplace retirement plans right now. The backbone of most Americans' saving strategy. In 2024, you could contribute up to $23,000 to your 401k, 403b, 457, or TSP plan. Now, in 2025, this limit has increased by $500 to $23,500. While this might seem like a modest increase, it's important to understand the long-term impact of even small changes in your retirement plan contributions. Over 20 years, that extra $500 annual contribution, assuming you get a 7% average annual return, could grow to more than $20,000 in additional retirement savings. For those of you who are over 50, the catch-up contribution limit remains the same at $7,500 for 2025. This means you could potentially contribute up to $31,000 to your workplace retirement plan in the year 2025. This applies whether you're making traditional pre-tax contributions or whether you want to make those contributions as Roth contributions. It's worth noting that this opportunity to contribute additional funds in your later working years can be a powerful tool for boosting your retirement savings when you're likely at your peak earning years. One of the most significant changes affects the combined contribution limits with employer matching and profit sharing piece. The limit on these types of plans jumps from $69,000 in 2024 to $70,000 in 2025. For those of you who are over 50 and are in this type of plan, whether you're a business owner or not, that brings the total possible contribution, including catch-up, to $77,500. This increase is particularly relevant for high income earners and those of you who are considering mega backdoor Roth conversion strategies. Now, let's discuss one of the most intriguing changes coming in 2025. The introduction of what's called the Super Catch-up Contribution. This provision, established by the Secure Act 2.0, creates a unique opportunity for those between the ages of 60 and 63. If you fall within this age range, you'll be eligible to contribute an additional $10,000 to your 401k or 403b plan. While this extra contribution allowance is certainly beneficial, the narrow age window raises some interesting questions about the retirement policy designed for these super catch-up contributions. From my experience working with clients in this age range, I've found that having more contribution flexibility in the years preceding retirement can make a significant difference in their retirement readiness. For part-time workers, 2025 brings welcome changes that could dramatically impact your retirement savings potential. The eligibility requirements for joining company retirement plans are becoming more inclusive. Currently, you need either 1,000 hours in a single year or 500 hours over the last 3 consecutive years to be able to participate. Starting in 2025, that 3-year requirement drops to just 2 years. This change acknowledges the evolving nature of our workforce and provides more people with the access to employer-sponsored retirement plan benefits. A particular significant development affects all new and 401k and 403b plans established after December 29 of 2022. These plans must implement automatic enrollment for eligible employees unless they specifically opt out of the plan. The initial contribution rate will be at least 3% with automatic annual increases to 1% until reaching between 10 and 15%. From my years of experience helping clients plan for retirement, I've observed that automatic enrollment is one of the most effective ways to help people start saving early. It removes the psychological barriers to getting started and help creates a positive saving habit for those employees. For my self-employed clients, the solo 401k changes in 2025 present some exciting news. As both employer and employee, you can contribute up to $23,500 as an employee contribution, plus up to 25% of your compensation as an employer contribution. This brings the total possible contribution up to $70,000 for those of you under 50 and $77,500 for those of you over 50. And if you're in that special age from 60 to 63, you could potentially contribute up to $81,250. These higher limits create powerful tax planning opportunity for many business owners. Let's shift our focus a little bit to individual retirement accounts such as IRAs, which remain a crucial component of many retirement strategies. While basic IRA contribution limits will hold steady at $7,000 in 2025 or $8,000 if you're 50 or older, there's an important change that's coming to Roth IRA income eligibility that could open the doors for many savers. The income thresholds are increasing. Single filers now able to fully contribute until their modified adjusted gross income reaches $165,000, up from $161,000 in 2024. For married couples filing jointly, that threshold has increased to $246,000 from $240,000. This adjustment to income limits is particularly significant because Roth IRAs offer unique advantages in your retirement plan. From my experience working with retirees, having tax-free income options in retirement can be invaluable for managing your tax bracket and maximizing your Social Security benefits. If you're currently just above the 2024 income limits, these new thresholds might allow you to add Roth savings to your retirement strategy. For business owners and self-employed individuals, the SEP IRA landscape is also evolving. The contribution limit increases to $70,000 in 2025, up from the $69,000 in 2024, or 25% of your compensation, whichever is less. While SEP IRAs don't offer catch-up contribution like traditional IRAs, they provide excellent opportunities for business owners to save significantly for retirement while managing their tax liability. I've seen many self-employed clients benefit from the flexibility and higher contribution limits of SEP IRAs. SEP IRAs also usually offer lower plan fees than some of the 401k and solo 401k plans. Now, let's address one of the most crucial changes that many people need to be aware of. New rules for inherited IRAs starting in 2025. The IRS is implementing stricter penalties for missed required distributions from inherited IRAs. This is particularly important if you have inherited an IRA since 2020, as these accounts are subject to the 10-year distribution rule. The penalty for missing an RMD will be 25%, though it can be reduced to 10% if you correct it within 2 years. This change represents a significant shift in how inherited retirement accounts must be managed. At our firm, I've seen how proper planning for inherited IRAs can make a substantial difference in tax efficiency and long-term wealth preservation for our clients. It's critical to understand these rules and plan accordingly, especially since the IRS previous leniency period is ending. Let's turn our attention to what I consider one of the most powerful but underutilized retirement planning tools, the health savings account. In 2025, HSA contribution limits are increasing to $4,300 for individuals and $8,550 for families, with an additional catch-up contribution of $1,000 available to those over 55 and older. As a financial planner who does retirement planning every day, I often emphasize to clients that HSAs offer a unique triple tax advantage. First, you can make tax-deductible contributions. They also get tax-free growth, and if later on in retirement or if you have any medical expenses, you can take tax-free withdrawals for those qualified medical expenses. Let's explore some of the newer features being introduced to retirement plans in 2025. Starting with emergency savings accounts. This innovative addition allows employers to offer emergency savings accounts linked directly to employees' retirement plans. From my experience seeing clients, I've seen how unexpected expenses can derail their retirement savings, often forcing people to take early withdrawals from their retirement accounts. These new emergency savings accounts create a valuable buffer between your daily financial needs and your long-term retirement savings goals. Now, speaking of emergencies, the Secure Act 2.0 has introduced a more flexible approach to assessing retirement funds in times of need. Starting in 2025, you can withdraw up to $1,000 from your retirement account for emergency expenses without facing the typical 10% early withdrawal penalty. However, it's important to understand the repayment rules. You have 3 years to repay the distribution, and you cannot take another emergency withdrawal during that period unless you've repaid the first draw. While this provides a helpful safety net, I always advise clients to build an emergency savings outside of their retirement accounts whenever possible. Another change that's coming in 2025 addresses a common challenge many young professionals face: balancing their student loan payments with retirement savings. Employers will now be able to start matching contributions to a retirement plan based upon an individual's student loan payments. This is a major change and development for those who are struggling to save for retirement, also while paying off any education debt. For example, if you're paying $300 a month towards student loans, your employer could potentially match that amount in your retirement account, even if you're not making any direct contributions yourself. Now, let's discuss what I consider one of the biggest changes today. Another change coming in 2025 is some new rules for catch-up contributions. Let's discuss one major change that you need to be made aware of for any Roth accounts. Some new rules are coming down the pipeline, and I don't want you to be caught off guard. Starting in 2025, if your wages from a single employer exceed $145,000, any catch-up contributions to your 401k must be made as Roth contributions. This means you'll pay taxes on these contributions up front rather than getting an immediate tax deduction. Importantly, you won't be able to make catch-up contributions to traditional pre-tax 401k accounts, only to those Roth 401k accounts. While this might seem like a disadvantage, it's essential to consider the long-term benefits of this tax-free growth and withdrawals in retirement. This change to catch-up contribution represents a fundamental shift in retirement saving strategies for higher income earners. For someone making catch-up contributions of $7,500 annually, this could mean paying several $1,000s more in current year taxes. However, it also means building up a larger pool of tax-free money in retirement. I've found that having a mix of these pre-tax and Roth savings accounts is extremely valuable in your retirement income planning. The upcoming changes to retirement plans in 2025 bring both new opportunities and potential challenges for retirement savers. While some updates like higher contribution limits and increased flexibility for accessing funds and emergencies offer greater savings potential, others, such as the mandatory Roth catch-up contributions for high-income earners and tighter inherited IRA rules, demand careful consideration and strategic planning. At Gudorf Financial Group, we specialize in helping individuals over 50 through these complex retirement planning decisions. We know these changes can feel overwhelming, but they also open up new possibilities to enhance your retirement plan. That's why we offer a free retirement assessment. Together, we'll review your current retirement plan and assess how the 2025 changes could affect your financial future and identify ways to minimize your taxes, optimize your investments, and ensure you're on track for the retirement you've always envisioned. You can schedule your free retirement assessment today by clicking the link below or going to and visiting us at gudorffinancial.com/get started. Remember, successful retirement planning isn't just about keeping up with the changing rules. It's about applying these rules strategically to your unique situation. The 2025 updates introduce new tools, but integrating them throughout your plan is key. If you found this information to be helpful, please like and subscribe to our channel for more retirement planning tips and insights. Click this video here if you want to learn more about how to reduce your taxes on Social Security benefits. Have a great day.